Hello and welcome. You're watching us here on Chartbusters. I'm Manglam Malu. With me, Ekta Batra. Now, for the last few trading sessions, all the dips towards that 17,700 mark have been bought into. Today as well wasn't different. The only difference was the dip was a little deeper than 17,700. The low on the Nifty has been 17,642. The other part is that minor rallies had been sold into as well. The question is, how long can we decouple for? Whether today's dip can be bought into once again and the low of today has been maintained or not, we will know as we progress through the day. Hi, Ekta.
Hi, Manglam. You know, you mentioned the word decoupled, and that's exactly what the JP Morgan top team was talking about. The fact that India has seen so much interest simply because they have been decoupled, and this is despite higher crude prices. But let's see whether that sustains. Today, there's definitely trepidation and nervousness in the markets because of what took place globally ahead of the Fed meet next week. But these are top stories at this hour. It's a weak start for the Indian markets as global equities come under pressure. The Nifty moves below 17,700, led by the IT and auto sectors. Banks to slip, all other sectoral indices trade with losses.
After seeing a strong rally following news of a semiconductor manufacturing JV with Foxconn, Vedanta corrects after a release to the exchanges that clarifies that semiconductors will be manufactured not under the listed entity but under the holding company Vulcan Investments.
Delta Corp trades higher after the stock moves out of the F&O ban list.
VRL Logistics is the other stock in focus, mildly higher today but has rallied this week as the company has decided to sell its bus division to promoter entity for about 230 crore rupees. But we do have a lot of individual stocks which are doing well. Pharmaceuticals actually stand out. Perhaps it's because Ekta has joined us on the show today. Sun Pharma is at the high point of trade. Cipla is the other one which has moved to the high point of trade as well. Ashish Kyal joins in for a quick technical check on the market. Ashish, we've seen all dips towards that 17,650 to 17,700 being bought into. The question is, how long can that continue?
Hey Mangalam, morning to you, to Ekta as well, and to all the viewers. See, the overall tone for the market is sideways. As you rightly pointed out, any dips that we are seeing, this is a buy on dips market. That's what everyone is looking at right now. But there is a very classical double top that we see on the Nifty around that 18,000, 18,050 mark. There is an RSI divergence, which means that the momentum has slowed down on the upside, which we were seeing earlier. Also, what remains concerning is that Dow Jones is back below that 31,000 level, and in our rush, it is falling very sharply. And we can't be, I'm sure you might be talking about decoupling, but really, if you go and check the history, decoupling has not been extended for an extended period of time. It has not lasted for an extended period of time. It can continue for a short term, but over the period of time, if US continues to collapse, we cannot buck the trend and go up. We will at least try to catch up to some extent on the downside. Having said that, I think for today, if Nifty manages to protect that level of 17,640 on the downside, we might start seeing some kind of a pullback, but that should be temporary. I will use that pullback as a shorting opportunity for a target of around 17,500 on the downside, as long as the gap area, which is around 17,850, remains intact. So the trend right now for today is going to be sell on rise for me.
All right, take that point, Ashish. Individual stocks then, what do you have? Because at sell on rise, would you take a few long bets or would you go for some shorts as well?
I'll try to add one long and one short. I like to add Bharat Dynamics on the long side because individually we can see the stocks are still exhibiting their own independent wave pattern. And Bharat Dynamics gave a very classic breakout with a good volume, formed a consolidation triangle pattern for some time and giving a breakout today. So looks a very classic breakout on the upside with volumes. One can create long positions. Stop loss is 884. Target can be 981. And on the sell side is Havells India. We can see some kind of a slowing down on the upside. There is a divergence. It's now moving below its 20 days average as well. So Havells India will be on the sell side, maintaining a stop loss of 1385 for the target of 1245 on the downside.
Okay, all right, Ashish. We're going to leave it on that note. Thanks very much for joining in and have a great weekend as well. Let's shift focus now to a special segment where we will get you a few ideas for profit from Money Control Pro. Jitendra Gupta of moneycontrol.com joins in now to talk about a stock that he's been tracking very closely. Jitendra, over to you.
KC International in March this year, when it was trading at around 400 levels, the stock has made a bottom at around 390 levels and then moved up currently at around 450 levels. We still feel there is great value. Stock is quoting mainly at about 14 times its fiscal 24 estimated earnings, well below its long-term average, which is again around 14 times for 1 year forward earnings. Moreover, this should be seen in the light of recovery in the business and strong order book. In June quarter, it reported good 31% year-on-year growth in revenue, led by strong execution and orders in hand. This time, the T&D business, which was lagging behind, has reported a good 17% year-on-year growth. The non-T&D business, as usual, delivered a strong 46% growth in revenue. If this performance continues with a strong execution as we saw in the last quarter, earnings are going to be much better this year. It is sitting on an order book of close to 23,700 crore, which is 2 times its revenue, providing very strong revenue visibility. Overall, risk reward is quite favorable at this point in time.
All right, take that point, Jitendra. Thanks a lot for that. Take a short break. On the other side, we'll get you conversation with an interesting management, that of PDS Limited, to discuss their business, the business model and the growth prospects. Sanjay Jain, who's the group CEO, joins in.
Welcome back. Well, you're still tuned into Chartbusters on CNBC-TV18. It's turning out to be a bit of a down day for the market. So the Nifty is down around 158 points at this point in time. And the Sensex also over 500 points knocked off on that particular index. But let's discuss one particular stock on our radar today, PDS. The company is a supplier and manufacturer to over 190 fashion brands and retailers globally. Let's bring in the CEO of the company, Sanjay Jain, to understand how the business is panning out given the current environment with rising inflation, recessionary fears looming, and the Russia-Ukraine war. Have supply chains taken a hit for the company? What's the impact on the top line and the overall business, especially margins? Mr. Jain, hi, welcome to the show. I was just reading a little bit about the company. Your sourcing segment, which is basically sourcing for all of these retail brands, fashion brands, is around 95% of your revenue. Can you explain to us briefly what the business model of the company is and how are you managing such stupendous growth, which is, I think, over 40% in the span of 1 quarter?
Yeah. Hi, Ekta. Morning. I think notwithstanding the recessionary trends across Europe and other parts, we have actually grown 40% plus in the first quarter. And sourcing as a service, in fact, is a new segment that we have added very recently. But the main segment is design-led sourcing, which is more than 90% of our top line last year and continues to be so. In this segment, we work with leading retailers, and we have our own designs that we take it to them. And from design to sampling to actually getting orders and sourcing from our 600 plus partner factories across the globe is the nature of the business that we perform under this segment. So it's basically for all global leading retailers, end to end from a design stage to actually getting the goods manufactured and then getting it delivered is the service that we perform to these customers.
Take that point, Sanjay. Thank you for explaining the business. And from what we understand, all the jargon of sourcing as a service, etc. aside, what you basically do is just connect brands to a bunch of factories that you have and while you help them design, etc. as well, you make a small little margin on this transaction. Is that correct? If I'm getting it to the basics?
No, Manglam, it's not the correct representation of what we do. Actually, we bring in tremendous value to the retail customer. For example, a Primark or a Tesco, or a Next in UK, I would actually be engaged with them 6 to 9 months ahead of the season, bringing in the expected trends to them, therefore bringing in the designs to them and getting those designs approved, getting samples to them, and then actually taking the responsibility of getting them manufactured across my partner factories. I'm using the word responsibility, therefore getting that factory onboarded, making sure that there is ESG compliance, making sure that the entire working capital is managed. I act as a principal who takes the responsibility of getting manufactured, buying them, and then selling them on to retailers. So there is a lot of responsibility beyond just earning a commission over here.
Okay. Mr. Jain, what Mangalam and I were discussing before the interview, in fact, are your margins, because your gross margins are over 15% but your operating margins come down to around 3.1%. And correct me if I'm wrong, in the previous quarter, you did have some monetization of land, which aided your overall numbers as well. So why are your margins so wafer thin? And when do you expect a sustainable improvement? Because your revenue could be great, but it's not filtering down into your operating margins.
I think our business model is B2B, wherein to expect us to go beyond a 5% PAT margin over the next 2-3 years, we won't be able to get there. But as a B2B company, maintaining a 15 to 17% gross margin, gradually augmenting it because of the new nature of the services that we are adding to our portfolio, given the strong growth momentum, as a result, the operating leverage that I'm going to get. Therefore, I should be able to sustain a 4 to 5% PAT margin. But most importantly, what I should be judged as a company is the return on capital employed that I'm generating for my stakeholders. PDS operates an asset-light model and operate at 30% plus return on capital employed and generate strong free cash flows with a net debt negative balance sheet. So notwithstanding a relatively low margin, I anticipate that there should be continuation of 30% plus return on capital employed and strong free cash flows from our company.
Right. We take that point, you are generating strong free cash flows, you're generating higher return on capital. Could you then give us a sense of what's the kind of revenue prognosis that you have for the next, say, 2 to 3 years? And secondly, what does that mean in terms of free cash flow to the firm? Because you don't have a lot of capital expenditure because you're asset light, etc. And what do you plan to do with that free cash flow? Because, I mean, the last couple of years I'm looking at it, your dividend payout isn't too high as well.
Yeah, so we had anticipated, for example, in the current year, a 12 to 15% growth for the entire year. And in the first quarter, we've actually grown 40% plus. And given the strong order traction, we anticipate a good growth momentum. But over a longer horizon, we expected from about 8,800 crore last year, we would actually double up to about 18,000 crore over 5 years. That's kind of a mid-teens growth. And we feel we are well poised to get to that stage. Now, in terms of the investment it may require, for this addition of 9,000, 9,000 last year to doubling up, a typical manufacturing unit might have to invest close to 2,000 to 3,000 crore as capex. Whereas in my case, given that I onboard factories through a careful selection process, my investment would be insignificant in terms of capex. And secondly, given we constantly endeavor to work through negative working capital or insignificant working capital, we anticipate that from my free cash flow, I may not be required to invest more than 10 to 20% of the free cash flow every year to achieve this growth momentum.
Exactly.
And,
so that 80% comes back to shareholders as dividends?
So the board of directors of the company last year endeavored and year ended March 21 to adopt a dividend distribution policy of 25% of the profit to be paid out, which is what was followed last year. And for year ended March 22 as well, the dividend payout has been more than 25%. I guess as the company keeps stabilizing generation of free cash flows, the management would recommend the board to consider appropriately. But for now, 25% payout is the dividend policy adopted. And allow me to add one more point when I mentioned about the growth momentum. This is primarily, as Ekta said in the beginning, design-led sourcing giving us this growth. In the last 6 to 9 months, our company has very, very carefully added a new initiative of sourcing as a service. And I'm very pleased to inform you in 9 months of initiation, I have actually 8,000 crore of order book, wherein the leading retailers like Hanes, Ralph Lauren, Sainsbury, S. Oliver, and now very recently we are engaged with a large UK retailer. I have signed these kind of contracts for acting as an exclusive sourcing agent for them from various geographies in the eastern part of the world.
Okay, so you'd be an exclusive sourcing agent. That's important to note. But so you have these, your plan is to eventually hit $2.5 billion in the next 4 to 5 years. How exactly are you going to achieve that, Mr. Jain? And tell us, where are the margins going to be at that point in time? Revenue could be $2.5 billion, but at what margins would you be operating at? What is your profitability that we could expect?
Yeah, so the design-led sourcing business, given my engagement with close to 200 customers, I would grow in line with them. Plus, I'm trying to get a larger share of wallet through new categories like home, like accessories. And I've also increased my effort into new geographies, like US is now 20% of my sales. It was 9% 3 years back. I've started entry into Australia as well. So new categories with existing customers, adding new customers, entering the new geographies, that is in the design-led sourcing. Plus what I just mentioned, sourcing as a service. I think these two would be the building block. On top of it, the brands business. We have been selected as the exclusive licensee by Forever 21 and Skechers Kids category for the Europe and UK part of the world. So these are the brands-led growth. So these are the building blocks 1, 2, 3. And now on the margins, I think we anticipate, because of the addition of new categories, because of source service being higher margin category brands, margins should expand in terms of gross margin 100 to 200 basis point. But you would see the more traction in the net income margin, which I believe we anticipate them to scaling up to 5% net income to sales in about 5 years from now.
Okay, just quickly, Mr. Jain, you have real estate which you're looking to monetize further. Can you tell us if that's happening? How much is it worth? Quickly, if you could just be brief about it.
Yes, we monetized last year a non-core asset. This year as well, we have focused on warehouse, and we are going to monetize it. In fact, we have actually concluded the deal to monetize a warehouse, which is worth about £6 million, and that's approximately 50 odd crores, and we monetize it at a good profit as compared to the book value. That deal is concluded on non-core asset monetization.
It's interesting because, you don't need any capex, and on top of that, you're monetizing a lot of the assets that you have. And a lot of it still hasn't found its way to shareholders. You're saying 25% of your profits go back to shareholders as dividends. Be that as it may, talking about shareholders itself, I'm looking at your shareholding pattern. Institutions don't hold any stake in your company, any significant stake. We just have a couple of FPI entities holding about 2.5%. But you are, uploading presentations on the exchanges. You are holding conference calls, etc. Is that an effort to get institutions on board? Have you been speaking to them? And can we hear of any institutions, participating in your story as you are promising? What's the USP for an investor to come in?
I think, Mangalam, our job is to deliver the business plan or the expectation our stakeholders frame from us. That is first responsibility. Second is to communicate this effectively in as much as possible to our stakeholders. That is what the management has been trying to do. And we have adopted a more effective communication last few quarters. And I think some of the research houses also have initiated coverage on the stock. So I guess allow us to keep delivering on the performance, keep communicating. And I think it's a matter of time that institutions would also notice what we are doing. So hopefully it should lead to its own logical consequence.
Okay, take that point. Thanks a lot for joining in, giving us all those details on the business. Hope to speak to you more often and perhaps get some more out of you on what the plans for the US business and Europe in the near term are as well, because UK and Europe account for nearly 3/4 of your revenue. And we are seeing some macro challenges there. With that, we take a short break, come back. On the other side, we get you more on the markets and individual stocks. Welcome back. While the Nifty is meandering around that 17,700 mark, we have a couple of mid-caps doing well. And in that, it's the cement pack where every dip has been bought into. Ambuja Cements has now recovered about 3% from the lows. India Cement too has recovered about 3% from the lows. So these are the stocks which are outperforming out here. ACC too has recovered, but still is in the red. Ambuja has moved back into the green. And we do have a lot of the other names which are recovering from lows. But, the best stocks today, or the best performing stocks today, belong to the pharma pack. Among the top gainers on the Nifty, we have Sun Pharma as well as Cipla from the broader markets, currently at the high point. With that, we wrap up on this edition of Chartbusters. Thank you for watching. Trading Hour comes up next.